Eric Mwale. Today is August 19th, 2014, and today Google is celebrating 10 years in the stock market. So it IPO'd 10 years ago, and we can see it being featured here on CNBC's website. And I think it's appropriate we go and take a look at the chart itself, so we see whether we can understand why some stocks do well in a stock market as opposed to other stocks. So let's go to the current weekly chart. And on this weekly chart, it's a 2-year weekly chart. I want to show you some areas in the stock where it makes a lot of sense why people should be playing breakouts. So this was a previous weekly closing high there in 2012, and the breakout took place here. So that was your entry price in an ideal market situation. What's interesting is the market eventually, weeks later, came here and tested the same breakout and found support. Again, there was another entry level here. After a couple of weeks of settling down, the stock broke out. So your buy point is always when it moves above the previous weekly closing high. And again, here you see an example of an area where it did not work. And it's important to stress that not all breakouts are successful. You can see here that there was a weekly closing high there. The stock was breaking out again here. It did so, but failed. And you can see it had 1 week above that line here, 1 week above, and then subsequently went down. So in theory, you are supposed to get out. It's important for us to stress that not all breakouts are going to work, even for the best performing stocks. Sometimes they just stall. Maybe market conditions are not good, whatever reason, but not all breakouts are successful. It's important for us to recognize that. But what you do after a failed breakout, you can get out in an ideal situation. Okay, so what you do is you adjust your entry level, and let's start again here. So you had a failed breakout here, which was this failed breakout there. So you get out, and so now you adjust and you change the next buy point, which becomes now the next breakout above the new weekly closing high. So that would be here. So you set an alert at about 450. The next time the stock jumps above 450, you want to be a buyer if you can get into the entry level there. So that's one thing we can see from this IPO over the last 2 years. But I also want to show you something I think which is interesting here, or powerful, in the sense that the stock generally came from about 230, split adjusted, and went all the way to 600. So that's almost 100% gain, 90% gain since the lows here. It seems like a nice straight shot. So I always talk about some stocks having ugly charts and some stocks have very beautiful charts. Now Google is a stock that has a beautiful chart, and the way you find out whether a stock has a beautiful chart is whether its monthly chart is got some type of symmetry or some type of nice action when the stock is moving high. Of course, you don't want to own a stock in theory when it's moving sideways. That's kind of boring. You get frustrated. You'd rather buy it when it's breaking out here. So using that information, we can see that theory here is the next buy point is when the stock moves above this recent weekly closing high here, just above 600. That will be the next entry point. And some people would say that this is a nice cup handle and a potential breakout situation. So that's one way to look at it. Or you can actually even use this all-time weekly closing high as your buy point. Remember, nothing is set in stone. You can adjust your entry levels based on different price levels that you consider legitimate. So either you can use this weekly closing high there or the all-time weekly closing high. What I was talking about here was the monthly chart, and so now we see a monthly chart for the stock on a 3-year basis. Take a look at this nice action on a monthly chart, because the monthly chart tends to take away all the noise. So this is a nice action here. Okay, notice what happens when the stock moves above 69.10, which corresponds with this nice move from this breakout here to the highs there. Now let me take that off. On a monthly chart, your entry level again is the previous monthly closing high. So in this particular instant, monthly closing high was here. Your next entry level is here. this particular buy point here, that was your buy point during the breakout here. So the previous monthly closing high becomes your next entry level. So you set an alert and forget about it. Once the alert is triggered, then you go back and revisit the stock, see whether it's good for you on a buying basis. Here also you can see in an ideal situation, the entry level was here. Now the one thing I would like to stress is not all breakouts work. You can see here that on this monthly chart, there was a failed breakout, and it happens, and you should respect that. It happens, no big deal if it happens. When you're holding a stock, you just know that you need to get out. There was a breakout attempt above this previous monthly closing high there, and so the breakout attempt, let me show you here, tried to break out and failed. And so people always ask me, when do you buy? Do you buy at the end of the month when you're looking at a monthly chart? You just buy it on the day you see it moving above your buy point. Ask questions later. In this particular case, the breakout failed to hold above that level, and so you're supposed to get out during this phase here, get back in the stock when it next breaks out successfully, which is here. So some breakouts are good, some don't work, and it happens. So on this chart, the next buy point for the stock can be here, which is the current all-time monthly closing high. The current monthly closing high is your next buy point. Whenever the stock can break out above that, then that's your entry level. You can see the stock is already trading above 69.10. But what I want to talk about here is how beautiful this chart looks, because this evidence was already recorded in the stock's history, and I'll show you that on the monthly chart prior to 2012. As you can see here, a very nice upward trending move. But where did this stock get this type of action? If you go and take a look at the all-time data on a monthly chart for the stock, you'll see that it has a tendency of having nice gradual moves. Look at this. Since the IPO, post-split price, nice move here from about 50 all the way to about 230. It settles down again and has a nice move again from about 200 all the way to 350. That's a nice moving stock. Again here from these lows, nice move from about 150 all the way to about 300. Another evidence of a stock that when it's on fire, it tends to hold on to its gains. Again, you can see that recently. That's why after this evidence of gradual moves here and here and here, now you can see that it has another gradual move here. So the point here is, it is always good to make sure that whenever you are buying a stock, it has a good trading history. For example, let me give you an idea of a stock that recently I made the mistake of recommending to subscribers. Now, I made the mistake. I should know better. But you can see at this stock here, 10 years of data. In fact, if I go to all-time data on this stock, you'll see that the price is very erratic. You can see that it tends to have this up, down, up, down, up, down, up. This was a nice move, but then again, it was followed immediately by this move. And then we have this shaky move. It's not the most gradual. You just have to train your eyes on this aspect. So down, up, down, up, down, up. So my thinking is that even though I had made a mistake of not looking at all-time data, and I had recommended this to subscribers, is this could very be easily followed by a move down. So such stocks, you really have to be careful. To show you another one here. And you can see here's another stock that has a tendency down, straight up, immediately cancelled by down move, up move, down move here, and then up move. So let me take all that. You can see it's not consistent, and such stocks can really be very frustrating because you own them one day, the next minute they are down 20%. So you need to avoid such type of stocks. And actually, let me just run through some other examples of stocks that could have ugly long-term monthly charts. Here's another, and you can just see that the way it has this up over so many years, going back to 1999, 2000, tends to have this action. So when you own a stock like this, you gotta be aware that it could collapse at any time. Let's take a look at another one. Again, here's another one. This type of stock you should avoid just because the history of the stock is of too much volatility, not enough stability for a sustained move. So you can see here at the highs, you wonder whether it's gonna collapse. And also don't forget, I can see that it tends to collapse at this level on the RSI, on the monthly. So any reversal here could be catastrophic. See another example here. Well, this one is not as bad, but I personally would not be very comfortable holding this because of this movement, followed by that, which is immediately negated by that up, down, up. So you wonder that the next move is gonna be low. You gotta be careful. Also, always note where it stalls. This is where the stall comes. If you look at this chart, pause the video. Every time the stock sells off, it's at this RSI level. And so let me just show you that for the sake of explaining this. At this level, the stock tends to break down. Here, once it broke down below that level, was that high and a move lower. It stalled here, which was that high and a move lower. If it forms a double top here, which would suggest that that's a high, the next move could be lower. Let's take a look at another one here. And you can see lately, now this one had a nice run in between 95, the breakout there between 95 and 96. Nice move. Broke out from about $12.50, $13, went all the way to $50 in a straight shot. That's good. Problem is, after that, it's become a very volatile stock. Look at this. I mean, it's all over the place. And so there's no stability, there's no direction, there's no institutional support. I would rather avoid a stock like this and find quality stocks that look very good. Let's take a look at some names here. And I'm just gonna go off the top of my head here. Take a look at this chart. Look at that gradual move. And take a look at another one. Just off the top of my head from a recent video. Take a look at this one. And the stock had shown you potential. There was a nice gradual move here. Another gradual, nice sustained move there. Another nice sustained move there. In fact, you can even see a nice sustained move lower. And you can see recently this has taken place because the stock has a history of holding on to gains. And so the idea here is that Google has had a nice history of holding on to gains, and that's why it's a good stock. Let's take a look at one of the best performing stocks over the last couple of years, Priceline. And you can see that it had a nice sustained move here, took a break, had another nice sustained move, took a break, nice sustained move, took a break, nice sustained move. Let's take a look at Apple here over the years. It's long term, and you can see that had a nice sustained move here between 2003, which, and I have to say this because why not, is we got in here at $15. This was the entry level. Why? Because it met the ultimate Muade breakout here late 2003, early 2004. So the entry level on an ideal basis, on a timing basis, was here because it was breaking out based on our principles. But anyway, we are talking about nice looking chart. So you can see here another nice sustain after this nice move here, took a break for a couple months, and again had another long sustained move. And that's what you look for: long sustained moves and a history of long sustained moves. Eric Muade, good luck, peace, and blessings. Woo!